What if I told you that your next winning trade might not come from one strategy, but from combining the right ones? In this video, I'm going to show you 10 powerful trading strategies used by real traders every day to make consistent decisions in the market. But here's the thing. Think of each strategy as a building block. On their own, they work. But together, they create structure. And structure is what makes a strategy repeatable. Let's dive in. A fair value gap, or FVG, is an imbalance in price that often acts like a magnet. To plot a fair value gap, start by spotting a 3-candle sequence. You're looking for a large impulsive candle between two smaller ones. Now check the high of the first candle and the low of the third. If they don't overlap the middle candle, that empty space is your fair value gap, a price zone where no trades occurred. The market moved too fast, skipping through liquidity. If there's no gap between the high of candle 1 and the low of candle 3, there's no fair value gap, no matter how large that second candle is. And remember, this works in both bullish and bearish scenarios. So now you know how to spot and draw a fair value gap. Let's look at how traders actually use them. When price returns to fill the gap, it often reacts, either making a big move leaving only wick or consolidating before continuation. In uptrends, a fair value gap below price can be a buy zone. In downtrends, a fair value gap above price can act as a sell zone. The stronger the impulse that created the gap, the more likely that zone will hold and create a reaction. To improve accuracy, combine FVGs with market structure or confirmation candles. That way, your win ratio will surely increase. This is your FVG playbook. Spot the structure, mark the imbalance, and wait for price to return. No guesswork, just rules, logic, and high probability setups. Trendlines are one of the simplest and most effective tools to understand market direction. They can also be really useful in finding precise entries. A trend line is just a line connecting at least 2 or more swing highs or lows. Uptrend connects the higher lows. Downtrend connects the lower highs. The third touch of the trend line is where many traders enter, because that's where price either respects the trend line and continues the trend, or make a breakout and breaks the trend line. For higher probability, use trend lines with context. Like for example here, I used it with a fair value gap. And if you don't see a clean trend line, don't force it. Not every move needs one. But when it's there, it's powerful. Fibonacci retracement is a popular tool traders use to find possible reversal zones in a trend. Start by identifying a clear swing low and a swing high in a trend. Now apply the Fibonacci tool by dragging it from the swing low to the swing high. These horizontal levels act as potential support zones during a pullback. The 0.382 and 0.618 levels are the most common reversal points. But don't blindly enter on touch. Always combine it with confirmation. For example, a bullish candlestick pattern or a bounce with volume. Fibonacci works best in trending markets. Avoid using it in a choppy range. It's not a magic solution, but when used correctly, it gives high probability entries with clear structure. This strategy uses 2 powerful custom tools, EzAlgo and EzOscillator, built to simplify your trading decisions and help you find precise entries. Let's start from the beginning. Go to the Indicators tab on TradingView, scroll to Invite Only Scripts, and select EzAlgo and EzOscillator. They'll load automatically onto your chart. EzAlgo shows signals directly on the chart. Buy and sell points, support and resistance are marked out here. You don't have to use Fibonacci tool every few minutes because the indicator does this for you. What's cool about this indicator is that it also gives potential reversals based on AI. They appear as these triangles, but you shouldn't enter based on just one thing. The strength of this system is in confluence, combining signals at the right moment. That's where EzOscillator comes in. It works on Heikin Ashi based calculations and gives you confirmation on momentum, whether the market is really ready to move or just faking it. For example, here the price touched the resistance level. We can see a reversal signal as well as AI predict from EzAlgo. It lines up with a bearish divergence on the oscillator. That tells us that the price can reverse in a moment. We also got a massive move down, suggesting that sellers might take control. I would enter here, setting stop loss above these wicks and take profit at lower liquidity level. So instead of guessing, you're working with structure, signals, and momentum, all lining up in one place. If you want to get access to both indicators, you can grab them using the link below. You'll also get access to the EzTrades Discord, where you can find professional analysis, entry signals, a lot of educational materials, and many more. Combining liquidity sweeps with fair value gaps can give incredibly precise entries, especially when you understand where the market is hunting stop losses. First, what is liquidity? In trading, liquidity is where orders are stacked, usually above equal highs or below equal lows. That's where many retail traders place their stop losses. These zones become targets for bigger players who need liquidity to fill large positions. When price aggressively moves into those zones just to trigger stops, that's a liquidity sweep. It's not a real breakout. It's a trap. After the sweep, price often reverses hard. That's the key moment smart traders are waiting for. This impulsive move can leave behind a fair value gap, a zone of imbalance that we have talked about before. This becomes a high probability entry zone. Why? Because the sweep adds extra context. It shows intent to reverse and trap late buyers or sellers. The optimal play is to wait for price to return to the fair value gap after the sweep. If you enter there, your stop loss can go just below fair value gap and your target much higher. That's how you should trade with this insane strategy. Here's your execution checklist for this setup. Wait for sweep, find fair value gap, wait for price to return to it, wait for confirmation, and execute. Breakout and reversal patterns are some of the most powerful setups in trading, but only if you know how to read the context. When price gets trapped inside a small range for a while, that's called consolidation. Eventually, pressure builds up, and boom, price explodes out of the range. That sudden move is what we call a breakout. Now, here's the trick. Not all breakouts continue. Some are clean, strong moves. Others are traps. To spot a strong breakout, look for high volume and a clean candle close beyond the range. It increases the chances of a successful breakout. But sometimes, the breakout fails. Price breaks out, only to quickly reverse and go the opposite way. That's where reversal patterns come in. One of the most common signs? A rejection wick, where price breaks the level but closes back inside the range. Other reversal signals include patterns like double tops and bottoms, triple tops and bottoms, or head and shoulders. The key is, let price show its hand. Don't chase the breakout. Wait for confirmation or failure. Here is a quick step-by-step list for the breakout and reversal pattern strategy. Order blocks are one of the most precise tools smart traders use to find entries, but most people misunderstand what they actually are. An order block is the last candle before a strong move, usually the one just before a fair value gap forms. It's where institutions place big orders before pushing price in one direction. Price tends to return to these order blocks after some time, not because of magic, but because that's where unfilled orders might still be sitting. Most traders enter too late, after the move has already happened. But with order blocks, you let price come to you, and then you execute after some confirmation like break of structure. To trade well with this strategy, you have to find the candle before the move, mark the order block zone, wait for price to return, look for confirmation, then enter. Heikin Ashi is a modified candlestick chart that helps filter out market noise and reveal the real trend. Regular candles show every wiggle in the market. Heikin Ashi smooths that out, so you can actually see the trend. When you see green candles with no lower wicks, that means strong uptrend. If you spot red candles with no upper wicks, it means strong downtrend. You don't use Heikin Ashi to enter the market, but to stay in the trade longer. It's more like a confirmation tool. It won't give you exact price, but it gives you a clearer picture of what the market is trying to do. It can also help you understand what trend you're currently in. Candlestick patterns are one of the oldest tools in trading, and still incredibly useful for timing entries and exits. The goal isn't to memorize every pattern, it's to recognize when price action tells a story. Let's go through a few of the most reliable ones. A bullish engulfing happens when a large green candle completely covers the previous red candle, showing a sudden takeover by buyers. A hammer looks like a small body with a long lower wick, meaning sellers pushed price down, but buyers slammed it back up. A shooting star has a small body and a long upper wick, showing buyers tried to push higher but failed. A doji is almost a cross, tiny real body, long wicks both ways, signaling pure indecision between buyers and sellers. I recommend skipping trading when you see this. These patterns work best at key levels like support, resistance, or fair value gaps, and candlesticks show how strong that reaction is. Used alone, they're not enough, but used with confluence, they become powerful confirmation. Some traders use moon phases to time their entries, not as a standalone signal, but as an extra layer of confirmation. The idea is simple. New moons are often followed by bullish moves. Full moons can lead to bearish reversals. Not always, but often enough to pay attention. This works especially well when the market is at a key level, like support, resistance, or a fair value gap. The moon timing just adds that extra confidence to your decision. Don't blindly trade based on the moon. You can add the moon cycle overlay from TradingView's built-in indicators. Just go to the Indicators tab and type in moon phases. It's a unique tool. It won't work for everyone, but when it lines up with your technicals, it's surprisingly effective. You've just seen 10 strategies that real traders use to make better decisions. But watching isn't enough. The real edge comes when you build your own system, taking the tools that match your style and turning them into consistency. If you're serious about trading and want to level up, check out the link in the description. You'll get access to the exact tools and the community that helps make all of this work. Make sure to like and subscribe for more content. Also, let me know in the comments section which strategy you're adding to your playbook. You've got the roadmap. Now it's time to execute.